reception of your book in Paul Krugman's very positive review in the New York Review of Books was the phenomenon of very high salaries of managers, whether in the corporate sector or in particular in the financial sector, is something that doesn't fit so easily with a model that's about returns increasingly being to capital rather than to labour. And Krugman suggested that maybe you don't have as much of a story about that phenomenon as you do about increasing capital returns to capital. So, what's your response to Krugman's impression that he wants to?
No, I think he has a point, and I think the book is too short. I should have made it longer so as I can talk about all of this. So no, but I think there's not enough about financial deregulation. So I think he has a point. Now, there's not enough, but I do talk about financial deregulation and about the inequality impact of finance. And in particular, there are two important impacts that I refer to. One is that clearly it's a big contribution to rising top incomes, in the financial sector. And the other part of the story, which plays a big role in the book, is the fact that increased financial sophistication has probably increased the inequality in asset returns between different groups of people. So, the fact that a very large portfolio managed to get 7%, 8% return, whereas people with, 100,000 pounds can hardly get the inflation rate. I think, this huge inequality in rates of return to assets has a lot to do with the increased sophistication in financial markets. According to textbook model, it should not be like that. According to the textbook model, a perfect financial intermediation system should give the same high return to everyone. So everyone should come with 100,000 pounds and have your money invest in the highest yield project in China. That doesn't seem to work this way. Apparently, some people get very sophisticated product, get high return, and then they sell to the mass of the population assets that do not yield the same return. And that plays quite a big role in the book, and I think that's quite novel and that's fairly important. Now, on the rise of high-end incomes in the finance sector, I could have spent more time talking about that, and I think Krugman has a point. Although, if we look at the numbers for the US, finance is about 10% of GDP. The share of finance in the top 0.1% income earners is about 20%. So that's twice as much as their share in the economy. So Krugman is right, but at the same time, this means that 80% is outside finance. So 80% has to do with the rise of very top managerial compensation in non-financial large corporations. So, I think we should not, overestimate also the importance of the financial sectors. And, when we do, we have a paper with Emmanuel Saez and Stéphanie Stancheva where we try to explain the compensation package of top executive in large companies across European countries and the US and Japan. And we try to explain why is it that you have higher top managerial pay, in particular in the US and the UK. The financial sector indicators or the company size indicators do not seem to get you very far in explaining why the rise in top-end managerial compensation has been so much larger in the US and to a lesser extent in the UK. And the change in incentives due to the huge decline in top income tax rate seems to be more important in the sense that we see the elasticity of managerial compensation with respect to windfall profits to rise specifically in these two countries when the top tax rates were reduced a lot. And so, finance is important, but, it's more than just finance.
Can I just follow up on that? Do you think it might be conceptually difficult then to divide labour income from capital income for top managers, given that it's hard to see their incomes as a reward for marginal productivity? It looks more like a kind of a cultural, kind of a de facto capture of something that looks more like a capital return. Do you think that puts pressure on the distinction?
I mean, the distinction is always difficult to draw. It's an abstract notion, capital, labor, and in the real world, it always takes some labor to manage your capital, and this has always been an important justification, even back in the 19th or 18th century, you would have landowners or capital owners that will insist that it takes a lot of hard labor to get a high return. So it's always, the distinction is indeed always hard to draw. Now, in the case you mentioned, I think at least initially, at the beginning of a career of a top managers, the distinction is pretty clear in the sense that this is not capital income because this rewards. I'm not sure it rewards productivity, but it rewards some input that's not related to these people don't have a capital stake in the firm, at least initially. Then, of course, as time passes, they are able, through their compensation package, their bonus, their stock option, to have a capital stake. So now, indeed, it becomes complicated because they are part of the shareholder board and the decision-making process of the firm, as well as they work for the firm. So then the distinction is. But initially, most top managers don't have a large capital stake in the company, and even later on in their career, their capital stake is still quite small. So it's a reward for labor in the sense that it's a reward for being there as a manager of the firm. Now, are they able to get more than their marginal contribution to the firm as suppliers of labor? Yeah, I think sometimes they are. But it's still, it's an excessive remuneration for their labor, but this is still labor income. So I think it's clearer to analyze it as an excessive remuneration for labor income rather than call it capital. It's not because it's excessive that it's capital. Capital income means that it corresponds to the remuneration of some initial capital stake that you have in the firm.
Just one final point on the analysis of in this post-crisis phase that we're still in advanced economies. The argument's been made we're in a period of sort of secular stagnation, the Summers thesis, and so the argument posed to your book is actually R is going to be low, or could be potentially low for a long period to come. The return on capital may be for a long period to come. I wonder what your response to that is, and do you think this is just sort of a temporal phenomenon, and that the historical trends that you empirically document will return, or that there is we may be experiencing structural problems with demand in advanced societies, which mean that rates of return on capital will be harder to find?
I think here there's some confusion between the interest rate and the rate of return to capital. So the rate of return to capital is a much broader concept than just the interest rate. So, if the rate of return to capital was really going to zero, as Summer seems to argue, then the capital share in GDP, the capital share in the economy will be going to zero. Now, this has not been happening at all. The capital share right now, including 5 years after the crisis, is much higher than what it was 20 years ago in most developed countries. So what's in the capital share? Okay, you have interest payment, but you have dividends, you have corporate profits. Some of it goes into retained earnings, which feeds capital gains. You have rental income. Now, if you make the sum of all these forms of capital payment, the capital share has not been going to zero at all. So, I think this is just wrong just to take the interest rate and public debt as an indicator of the rate of return. I think public debt is a very particular kind of assets. It provides liquidity services. You can easily sell your treasury bonds, and that's why partly people accept to have a relatively low return as compared to other assets. And also, we are not completely out of the financial crisis yet. And also, we've had a lot of, creative monetary policies that has kept these interest rates low. Now, I think we've been, I think where Summers is right, or where if this is where he wants to get, is that we've been asking too much to creative monetary policy, in recent years, pretty much everywhere, in the US, in the UK, in the Eurozone. So, because at the end of the day, you have this very low interest rate on some assets, the public debt or certain categories of short-term or medium-term loans, but this is creating bubbles in other assets, real estate or some segments of the stock market. And so you have huge return on some other assets at the same time as you have zero interest rate on the public debt. So in fact, this is probably amplifying the inequality in rates of return and the huge heterogeneity in rate of return. So my bottom line is the average rate of return, all assets combined, is not going to zero. It has been going down a little bit over the past 20 to 30 years because of the rise in the capital to income ratio, but it has declined less than the increase in the capital income ratio, so that the capital share has actually increased. Point number two is that you have a huge heterogeneity in rates of return between assets, and that having a very low interest rate on certain assets, public debt in particular, it's not necessarily a good thing because it can dissimulate very high bubbles, capital gains, and rates of return on other assets at the same time.